Hi guys, it's your favourite YouTuber again, Dami Solari, and you're watching DS Learning Finance. Whoa. Now, I know you guys have missed me, but you know I'm consistent with this. This week's video is a continuation from the previous weeks. This is understanding the power of financial ratios 2. Now I've got 3 financial ratios to include to add to this series, guys. Want to know the important stuff? Want to know what they do? Do I need to say any more? Keep watching. Is the acid test ratio, otherwise known as quick ratio. This is calculated by the cash that a company owns, plus the accounts receivable plus short-term investments, all divided by current liabilities. It basically tells the shareholder how easily a company can pay off their immediate liabilities using their short-term assets. You want to aim for a ratio of close to 1. You definitely don't want too low, because obviously that's bad, and you don't want high. But some of you guys are probably thinking, why wouldn't you want high? I want a high acid test ratio, because that obviously essentially means that the company's got more current assets than it has liabilities, current liabilities. Yes, that is true, but at the same time it's yin and yang. It's about balance, guys. It's about managing debt. Not all debt is bad debt. You have some good debt. So a company that has a lot of debt doesn't necessarily mean that they're in a bad situation. It could be a form of good debt. So if you have an acid to test ratio higher than 1 for a company, a particular company, then that kind of means that the company is not reinvesting in other things. They're not giving back to shareholders. They're not fully utilizing that money that they have. And the next question that you should ask yourself is, why are they not utilizing it? So remember, you want to work towards acid to test ratio as close to 1 as possible. Now let me throw in a quick disclaimer. Obviously don't take this as set in stone, guys, because it does vary from industry to industry, but the general idea is you want it to be as close to 1 as possible. Number 2 is called beta. This basically tells you the closeness of your stock that you want to invest in, or that you might be already investing in, compared to the market. It tells you the closeness of volatility. So by volatility I mean in terms of prices going up and down. So if the stock market really crashes one day, how does your stock fare in respect of the market in general? Does it do better? Does it do worse? Or does it stay the same? That's what beta tells you. So when you have a beta less than 1, it basically means that the stock that you've invested in is less volatile than the market. So if the market's really doing badly, the stock should be fine, as long as obviously it's within reason. But generally they tend to withstand the test of time in terms of volatility of the market. You'll find that these stocks tend to be defensive stocks. So when you have a beta equal to 1, it means that the stock is literally just as volatile as the market is. So when the market's doing badly, you know that stock will do badly, and vice versa. When that stock is doing badly, then the market must definitely be doing badly. And on the flip side, it could be doing better as well. You can have a beta greater than 1, which basically means the stock is more volatile than the market. So it could be a good indicator of where the market might be going in the future. It could be a sort of predictive measure. So if a beta is like much higher than 1 and a company's struggling, then that could be a good indication. Or maybe all the other companies that have really high betas are all struggling. That could be a good indication that the market may be going down a bad road. And on the flip side, it could be if that company's doing really well and all the companies with a high beta can be doing really well, then maybe that's kind of like a prediction of what's over the horizon for the rest of the market. So yeah, beta tells you the closeness of your stock's volatility to the market's volatility. Number 3 is fixed asset ratio. This basically tells you the productivity of a company in using their fixed assets to generate revenue. So by fixed assets, it could be PPE, and by PPE I mean property, plant and equipment. So what does the company hold, and how effective are they at utilizing those assets into making them more money? That's basically what it tells you. So you calculate the fixed asset ratio by dividing the revenue that a company makes by the cost of property, cost of plant and cost of equipment. Now what I really like about this ratio is that there's not just one size fits all. It's not like the acid test ratio where you can kind of pick a number and guess. It's dependent on each and every company, not just the industry. The reason being is because some companies are really reliant on having a lot of fixed assets. For example, a mining company will have a lot of fixed assets because they'll have tons of machines to dig. So as opposed to a company like Google, who barely would have any assets, fixed assets, in terms of all that they'll pretty much just have is just computers, manufacturing team. But in terms of that, raw materials, compare that to a mining company, it's completely one-sided. So yeah, it's important to know that there's not just one size fits all. You have to look into each and every company. Is your company more like a Google, where they don't really rely too heavily on fixed assets in terms of properties, plants and equipment? Or is your company more like a, not just a mining company, but I don't know, a manufacturing company that is heavily reliant on those fixed assets? And that's the end of my video, guys. Did you enjoy it? I know you enjoyed it. But yeah, anyway, you know, keep watching, guys. Next week's video is going to be a good one. But before you can leave, before you can continue doing whatever you're going to do for the rest of the day, LSS, like, subscribe and share. DS Learning Finance.